Hi, class. Welcome to week 5. Yay! I know we're almost done. This is getting exciting. So, what do we have due this week? We know we have to read chapters 11 and 12, right? We know we have to do the discussion, the week 5 discussion this week. And we have to turn in homework 5. This week I decided to kind of do some examples from chapter 12, so let's get started. So, the first problem I kind of want to go through is this is regarding note payables. So, here, 2016, May 1st, we purchased equipment for $100,000 by issuing 10-year 15% notes payable. The note requires annual principal payments of 10,000 plus interest each May 1st. So every May, we're going to actually make the principal payments. So at December 31st, we're going to accrue interest on the notes payable. So the interest will only be for that portion of the year from May till December, which is 8 months, right? So January, February, March, April, that's the 4 month. We have 12 months, so we got 8 months left. Then we're going to do journal entries for 2017. May 1st, when we paid the first installment on the note, the $10,000, that principal payment that we got to pay each year. And then December 31st, we're going to accrue the interest payment on the note payable. So, we're going to journalize the transactions for the company. And considering the given transactions only, what are Precious Manufacturing Technologies' total liabilities on December 31st, 2017? So let's get started. So May 1st, we purchased the equipment for $100,000. So we got equipment now on our book. It's an asset for $100,000, and we got notes payable because we didn't issue cash. We issued a note, so notes payable that we have to pay for $100,000. So December 31st, we have to accrue that 8 months worth of interest, right? So you take the interest expense is 100,000 times 0.15 because it was a 15% interest, kind of a high rate, right? That's kind of a high rate. And then we're gonna times 8 divided by 12 because we're only doing this for 8 months. So that's 10,000. So our interest expense is 10,000 and the interest payable is 10,000. So this is May 1st. Next year we paid the 10,000. We paid the note for 10,000. So we have notes payable for 10,000. We're actually going to pay, remember that interest that we accrued at the end of last year for 10,000, so now we're actually going to pay it. And we're also going to have pay the interest for the 4 months, right? Because now we have January, February, March, and April that we have to account for. So that's the 4 divided by 12 for 4 months. So we pay 15,000 worth of interest expense and the 10,000 of principal that we pay every year. So cash altogether, we paid out 25,000. So December 31st, the accrued interest, it's going to be $9,000. So you're asking yourself, why is it 9,000 instead of the 10,000 that we calculated before? Well, we actually paid 10,000 of that principal. So that 100,000 went down to 90,000 because we paid the 10,000 principal. So that's why it's now 90,000 times the 0.15, and of course we only have 8 months, so that's why we're multiplying by 8 divided by 12 to get the 9,000. And here is just a listing of your liabilities. So we know that interest payable that we figured out on the previous slide, the 9,000, and then the notes payable of 90,000. So we have total liabilities of 99,000. The next problem that we're going to do has to do with the bonds, okay? So I don't know, many of you know, I probably said before, I'm studying for the CFA. The CFA is more of finance, so I just love talking about anything about bonds and stocks. So, sorry, let's just get to it. So, here, January 1st, 2016, Daniel Unlimited issued 8% 15-year bonds payable with a face value of 180,000. The bonds are issued at 102 and pay interest on January 30th, and December 31st. So, when this says the bonds are issued at 102, 102 means that we paid like 2% more than the par value. So we would have paid for this bond 180,000 plus 2% of the par. So this is how I do 2%. I'll say, okay, I know 10% is 18,000. 1% has to be 1,800. And then since it's 2, I'll say 1,800 times 2. So that's 1% times 2 is 3,600. So I'm going to pay a premium of 3,600. You might ask yourself, why in heavens would anybody pay a premium? You pay a premium for something when someone is issuing you a bond, so that bond is at 8%. If you're paying a premium, that means that if you went out into the market for a similar bond, they're paying less than 8%. So the market is giving you a lower interest rate. So that's why you're willing to pay more for a bond that's giving you a higher 8% interest. So that's why you would, and they call that buying something at a premium. That's why you can do it at the 102. The same thing could happen, we call it at a discount. Instead of that being 102, it could be 98. And that means that you're paying less than the par value. So I know that's putting in a little bit more than what, but I just kind of wanted you guys to kind of understand that. So let's kind of go through the requirements. We're going to journalize the issue of the bonds in January 1st, 2016. We're going to journalize the semi-annual interest payment and the amortization of bond premium on June 30th, 2016. We're going to journalize the semi-annual interest payment and amortization of bond premium on December 31st, 2016. And we're going to journalize the retirement of the bond at maturity. So a lot of times the bonds, we don't actually get back our principal until like the end when it's going to retire, mature, which for here it's 15 years. So all you get normally with a bond, I mean, there are other bonds that you can get principal payments, but normal, plain vanilla bonds, you don't get your principal payment until the end of the term. All you get is the interest, the bond interest payments. So you can see we have bonds payable for 180,000 because we're the ones that actually issued these bonds. How much cash did we receive? We received 183,600. Why did we receive 183,600 from bondholders for this bond? Well, because as I said previously, if they went out in the market, they're going to get something that pays them less than 8% for a similar bond. So they're willing to pay us a little premium, which is 3,600, because we're giving a higher interest rate. So this is for the semi-annual interest payment. So we're going to record the interest payment. So how do we record the interest payment? So you take the cash, it's 180,000, which is the par value. You have to take the par value. Then you're going to multiply it by 0.08, the 8%. but just for 6 months because we're paying these semi-annually. So that's how we get cash. The interest expense is actually gonna be it's gonna be, you have to take out the premium that we paid, which is the premium that we got, which is 120. So you take the 3,600, which is gonna be the total premium, then you divide it by 30 because we pay semi-annually and it's a 15-year bond. So that's how you get the 120. You take the 7,200 minus the 120, and that's the interest expense. And you can see that we would make a similar journal entry semi-annually at December 30th, 2016. And now we're going to retire the bond. So we're going to pay the bondholders 180,000 cash, and we're going to take off that liability off our books. So that's why we're going to debit bonds payable at the par value for 180,000. The next problem is to talk about classified balance sheet. So here at December 31st, Mad Style Metals owes 30,000 accounts payable, salaries payable of 10,000, income tax payable of 7,000. Mad Style also had 220,000 of bond payables that were issued at face value, which means at par, so that would be at 100, that require payments of 22,000 installment next year and the remainder in the later years. The bonds payable require an annual interest payment of 2,200, and Mad Style still owes this interest for the current year. Report Mad Style's liability on its classified balance sheet. So it's classified, so we're gonna classify between current liabilities and long-term liabilities. Current liabilities are liabilities that you owe within a 1 year period. So any liability, and you owe that amount within 1 year, then it's a current liability. So the accounts payable, the current portion of the bonds payable, the salaries payable, the income tax payable, interest payable, all we're going to pay within 1 year. So we have total current liabilities of 71,200. And then we have bonds payable of 198,000, and that's our long-term liability. Remember, even the bond, if there's something that we're going to pay within a year, we call it a current portion of it, and that would go in your short-term liabilities. All right, I hope you guys enjoyed this, and good luck this week.